Good morning, everybody. I'm Michelle, and I'll tell you a little bit about my background. And just so you guys know, this has been asked to step in rather unexpectedly, so bear with me a little bit as I acclimate to the environment. Jeff and Lisa will then introduce themselves, and then we'll go through some of the questions and issues that people have been thinking about in this space, and you see reflected in our agenda. By way of background, I was into systems dynamics and policy studies as a kid in college, a rather unusual major at the time. I found my way to Wall Street and leverage buyouts, which at the time was considered highly disruptive technology. And then in the course of learning about the capital asset pricing model, which I call a slow moving version of Black-Scholes, found my way into McKinsey & Company doing corporate valuation work and strategy work. From there, a group of us developed a spin-off in fintech, which we call fintech now. Back then, we call it technology and banking. And over the course of about a decade, we served the global 100 banks, but largely in technology-related issues around strategy, cost reduction, more efficient marketing, target marketing, getting to the point of thinking about customers as fighting over share of wallet. And fighting over share of wallet is probably an important theme for us to think about today in the blockchain world, because the blockchain world takes that early thinking of target marketing and fighting over share of wallet, knowing how many credit cards you have in your pocket, trying to capture share of your credit card. Now blockchain puts that on steroids. After my time in the consulting space, I got into product development, product management, and around 2010, I got into cryptocurrencies, actually blockchain to be Bitcoin to be specific, and I was a vol arb trader for a while. And now more recently, I've gotten back to my roots, and I've been doing a lot of strategy work and product development work in the cryptocurrency space.
Hello, everyone. It's great to be here in the state of Wyoming. I would like to thank the University of Wyoming for inviting me here to Stampede so I could share my thoughts on digital assets and what's happening in the space. My background comes from 20 years experience as a credit trader on the buy side. I also was involved in sales and trading at several investment banks, Citi, Bank of America, Bank of Montreal. From there, I pivoted into crypto in 2019. Originally just started trading crypto and learning how it trades, learning the infrastructure in the space, and then got involved in a couple of venture capital funds, got involved in security tokens, also was involved with a portfolio company that is doing crypto prime brokerage, and then got recruited to join FINXFLO as head of institutional sales.
Hi there. One thing I'd like to say before I introduce myself is I am so excited that we have incredibly smart people in this space. It's so refreshing to step into an area where every single person I speak with is just over the top. In their thinking, I think you do have to be out of the box to understand what this space even means. A lot of people that get intimidated early, I was petrified when I first learned about Bitcoin. I was like, oh my God, we're in trouble. What is the future of finance going to look like? That was my first thoughts. Accidentally, I got into this space, too old to trade anymore, had my 3 kids. And after 10 years of being a stay-at-home mom, I got back into the market. And it was just after 2008, after the crash, and I was desperately looking for a job. Got into the recruiting space just to kind of see what was out there, where I met a lot of very interesting people, and started my own company accidentally in 2011 off the heels of Dodd-Frank regulatory reform. And that really opened my eyes. That's basically what was the starter for me to say, this market is very, very messed up, right? How are we possibly ever, from the banking side, because I come from the banking side, how would we ever be able to adhere to these complicated regulations? Impossible. So what I saw was regulation really pushed innovation in a big way. So I think today that's what we'll talk about. Like, how did we get here? Why is this space moving so rapidly? And why are the banks trying to catch up right now? And they are trying to catch up because of the legacy infrastructure that they had and the complacency of making a lot of money, right? So this is a whole new world. Anyway, that's me, Lisa Seim. I have my own company called Strategic Exchanges Innovative Markets. I work for a law audit and accounting firm as well, as an advisor called Exemplar. So hopefully that helps.
Okay, so we're going to see how this goes, and I prefer to have a sort of flat conversation with everybody on the panel. But if need be, I'll go to the mic so that I can make sure that we speed things along, if need be. Okay, so we have about seven or so thoughts that we'd like to work through with you. And hopefully you guys will ask questions at the end. We want to have you guys ask very specific things and very general things about the industry as you see fit. The first issue I'd like to turn to with the panel is to see if you guys could give us a little bit of background on your views on the evolution of the digital asset space. And more specifically, you started touching on it a little bit there, Lisa, when you were talking about the banks and legacy systems. But perhaps you might put it a little bit in the context of Rogers' innovation curve, for example. Want to start, Lisa?
Sure. So the evolution of where crypto assets, where I've seen them come, is exactly what I just spoke about. But the innovation that happened really picked up pace quickly when so many people lost interest in original financial markets and started to jump rapidly into cryptocurrencies. And all started with the crypto kitty phase, which we all know about, and just continued to evolve until we basically hit a brick wall at some point. So I think the brick wall, the crash, as we were hearing, the crypto winter, was inevitable, but also necessary for us to kind of reset and everyone to kind of sit back and say, were we moving too quickly? Where were the regulations? There was no definition. There still is coming and still ongoing regulatory actions helping us to understand to understand what the regulation should mean, right? And then across various countries, it gets even more complex. And that's how I got involved working in the UK with the FCA and the very complex product of derivatives. So that really opened my eyes to how collaboration with regulators is really important. And working through those regulatory models with different countries helped, I think, to lay the groundwork of what we're starting to see today in DC. And I'm also really excited to see a lot more practitioners from our world, from the banking world, are now moving in to regulatory roles. And I think that's going to help because they truly understand the landscape. And I think we should see a lot of progress soon.
So a little question about that. It sounds, as I recall, we started very much in the retail world, and I was one of those little retail vol traders in the early days. And there weren't any regulations, and there were a bunch of the U.S. exchanges that don't exist anymore, right? And the regulators came in, and they've sort of changed the way we look at the world. So I'm hoping that you guys might talk a little bit about that transition, Jeff, from retail into institutional trading and how that formalization of the market occurs with the institutional traders and how that dovetails with Lisa's observations around the regulators and compliance.
Sure. Happy to talk about where we are today in the crypto markets. To kind of put this in perspective for people in the audience, today's crypto market is roughly around 2 trillion in terms of market cap, with average daily trading volume of about 113 billion. If you compare that to the traditional Forex markets, FX, that market has a market cap of roughly 2.4 quadrillion, with an average daily trading volume of roughly 6.5 trillion, right? So we're still in the very early days of this emerging asset class. In terms of what we're seeing with institutional adoption, the main driver of that, in my opinion, is a more favorable regulatory environment, more clarity from the regulators, though there's still some work to be done there. And also advances in security, institutional grade custody, which is another important piece of it. Michelle had mentioned, when Bitcoin and other digital assets first came out, it was mostly driven by retail traders, right? There were no institutions in the space at all, or high net worth individuals that saw the opportunity to invest and diversify their capital away from fiat. And we all know what's happening with fiat currencies around the world. So yeah, it's been an interesting journey for a lot of these companies. They've spent at least about the last 3 years, some a little bit longer, educating themselves, making sure that they understand the technology, participating in pilot programs, test programs, to ensure that they have the infrastructure in place to allocate a significant amount of assets. But the other interesting piece of it as well is it's not just around Bitcoin and Ethereum now. It's also altcoins. It's also ETFs. We also have other companies in the space that essentially have crypto equivalent of mutual funds, right? So there's a couple of different ways that you can choose to invest into digital assets. I'll hand it over to Liz.
Yeah. Ed, well, we're passing on the baton here. I think we've pretty much covered that piece of it. Let's go on with
Right.
I love passing this microphone back and forth. It's like a tennis match, right? Okay, so another topic I'd like to get into a little bit is the drivers behind blockchain-based digital securities. What has been driving this change? Like more specific than just FOMO, which is fear of missing out, right? And greed. I guess at times we are greedy, which is one of the reasons we look at these crypto markets and get all excited. So what are the other drivers that are enabling the institutional players to get into this market in a meaningful way? And let me just set the stage with one comment, and that is that the institutional players, there is a very high demand for Bitcoin and Ethereum in particular based ETFs. And our regulators can't permit them until the markets are stable, because the ETFs would end up in people's, for example, retirement portfolios, right? And so that the regulation that we have around traditional securities, the regulators would very much want to see those principles applied in our crypto space. And in fact, they've written about it pretty prolifically. There's an international organization of security commissions. It has all of our top regulators in that as part of that commission, meaning the SEC and FINRA and the similar CFTC, and similarly situated institutions across the G7. And they have already written a paper about what they think where we should go with blockchain regulation and cryptocurrency regulation. You can find their paper online, and they're pretty specific about wanting us to evolve into the kind of security and consistency and transparency we see in conventional markets. The other piece of information that you should probably have is that the G7 have also announced that they're planning to release central bank digital currencies. And the G7 are saying that they're looking to do this in the next 7 years. So we're kind of on this glide path to the regulators trying really hard not to stifle innovation. And probably Wyoming is at the forefront. And I work with international students and international organizations. The Europeans constantly look to Wyoming to see the forefront of American thinking with respect to regulation. And so because they're all going to be releasing these digital banks, these central bank digital currencies, we can well expect that for efficiency alone, all of the large institutions will want to see the digitization of equities and bonds, et cetera, right? So it's with that backdrop that we talk about drivers.
Yeah, and I'll just add a couple of quick comments to that. So when Michelle talks about other digital assets, that also references interoperability, right, between blockchains. And not only that, but what we all know very well, treasury markets, equity markets, fixed income bond markets, all those markets will be moving on to blockchain. In fact, a lot of them, the transition has already started. I know of multiple different derivatives trades that have already been placed onto the blockchain using smart contracts between some of the largest investment banks out there. You have companies like Paxos, for example, getting their no action letter from the SEC. Paxos is essentially building a institutional grade custody for digital assets that, in my opinion, will compete with DTCC, which is the Central Depository Trust Corporation. And that's where all of our traditional capital markets trades settle. So there's a tremendous amount of innovation happening here in the space.
And that touches upon a really interesting piece of information. Traditional securities, the traditional markets, we've seen also incredibly out of control, AKA Robinhood, right? So looking at Robinhood more closely, and not to pick on them, but I mean, it was national news and everybody knows about it. The inefficiency of their operations, it was clear. Right? They obviously did not have all of the workflow. They hadn't thought through a lot of the pieces that are critically important to lay down a framework, a regulatory framework. It was just missing. And I think this opened a lot of people's eyes about the regulatory framework that you need to have in place, because so much can go wrong. The operational risks that are out there today, we have to look at differently than the operational risks of, back in the day when you had one full system end to end that cost millions of dollars per year to run. Now you can have much less, they're more cost effective, much less expensive, but you have to be very careful to lay out the framework because things can go wrong. And I've been working with companies where things are going wrong. And this is where we're seeing the headlines and the enforcement actions that are coming or that have been coming. I think they're really building up now, those enforcement actions, and they're really meant to open the people's eyes because follow the regulatory framework. It is really written pretty clearly out there, but people tend to not want to embrace it, right? Well, I didn't really understand what they meant. That can be that can be a big problem. So that's what I do. I try to get firms to understand the risks across their workflow. Really, really important stuff. And I think that's the biggest take home of this whole industry change is get that in place first. Stop the marketing first. A lot of these firms are going out and they're marketing before they even have their infrastructure set up, and they're selling their system before it even works. Really important. So I'm excited that Mary Beth Buchanan will be speaking right after us at 11 o'clock. And I think she's really going to hit on a lot of those components that are mission critical for today's world.
So Lisa's been talking about the value delivery system, and that, when you think about the retail traders and this being an engineering driven industry at the moment, right? As software developers, young software developers using modern computing languages, taking advantage of the cloud. And so their perspective on value delivery systems is going to be relatively limited to those who have been in the industry for decades, right? And who understand not only the regulatory environment and the assets that we're protecting from, pension assets to hedge funds trying to get returns to their investors, but they also understand the actual infrastructure that has to be put in place and the complexity of it. And then finally, remember we talked about at the very beginning about the banks and the legacy systems evolving to the point of a market of one, right? That's the fantasy of every bank, of even Google, is to target you as a market of one. And it's against that backdrop that we watch this evolution. And we can see that, as Lisa was pointing out, that people are developing systems, anticipating, jumping over the steps of making sure they have a complete value delivery system and having a clear target market. But in addition to that sort of, the financial innovation, the technology innovation from a software language perspective, the invention of Bitcoin by Satoshi Nakamoto, that sort of financial innovation is just one piece of the puzzle. And I'm hoping you guys now might talk a little bit about some of the actual drivers along that value delivery system. So regulatory compliance, liquidity, liquidity. I felt it as a little retail trader. I would, buy Bitcoin in the U.S. market and sell it in the Russian or the European markets, and I had to repatriate that money back to the U.S. in order to have liquidity to continue trading. So I felt it as a little guy. Remember, these markets started out with retail players, and we're moving into institutional. So liquidity is an issue for the institutional players. For those of you who know Bitcoin, it takes 20 minutes. Right, to confirm a Bitcoin transaction. That's a very long time for traders, apparently. Security, we're kind of curious to understand better security. I personally have had a lot of Bitcoin stolen in my early years, so we can talk a little bit about that. I hope you guys will, as well as custody, and a little bit about the technology infrastructure itself.
Sure. So for those of you in the audience that maybe don't know about FINXFLO and what we do, I'm just going to briefly give a little bit of background about FINXFLO. So essentially what we are is we're a central marketplace for crypto trading. We aggregate 35 centralized exchanges and DeFi exchanges and create essentially one marketplace where everybody can come, whether it's retail or institutional traders, to get the world's best price. And this is a natural progression. We have a platform called Market Access in the traditional capital markets. Market Access was a platform that was created by BlackRock, one of the largest institutions in the United States and maybe even the world in terms of assets under management. They essentially created Market Access. They invested in Market Access, only probably a few $1 million in the seed round. That platform today is now where 80% of fixed income trading happens. And that platform today is valued at roughly around $17 billion. FINXFLO is essentially doing the same thing. To go into a little bit more about liquidity that we're seeing in the market. I talked to a lot of institutional accounts, both crypto-focused hedge funds, more traditional focused hedge funds, insurance companies, corporates like MicroStrategy, for example. These guys, when they look at the overall market, it's still very fragmented, right? Pricing liquidity is not as deep and is not as transparent as what these guys are used to experiencing when they trade in traditional capital markets. So that's over the course of the last few years, it's started to get better. It's increasing, but there's still a lot of work that we need to do there. In terms of custody, we've seen a lot of new custody platforms come out. If you look back, 2016, 2017, we really didn't have any custody infrastructure in the space. That was another huge roadblock for institutional accounts to come in. Now we've seen companies that have been building what these guys are used to in terms of segregated institutional grade custody to protect your private keys and to make it very difficult for hackers to get in and to gain access and essentially steal your crypto. This is sub-account segregated custody, where if a hacker has to come in, they have to actually break into each individual sub-account. If they just gain access through the top of the house in this custody platform, they cannot access everyone's accounts. That's a very important piece, especially for large institutions that are in the space, because they have regulation and compliance that they need to follow, and this is part of it. In terms of interoperability, that's also an interesting area that we should talk about, because another thing that FINXFLO does, we're one of the first crypto trading platforms out there that have actually built bridges to other chains besides Ethereum. So if you trade at any of the large institutional exchanges out there, all those trades go through Ethereum at the moment. We've internally built a bridge to Tron and also BSC. So that's another interesting aspect of the market. Other interoperable blockchain protocols that are out there will help the industry lower fees, increase processing speeds. That's another piece of it. Like Michelle mentioned, in terms of trading Bitcoin, the Lightning Network does help with that, but there's still work to be done because these guys are used to trading and knowing what their risk is right away and holding those coins. So yeah, we need to continue to work on that, and we'll get there. There's no doubt in my mind as more and more institutions come in. That will help build larger pools of liquidity. That should also help balance out some of the volatility in the marketplace. Right now, it's extremely volatile at times, and most of that is with derivatives trading, right? This crypto markets are automated. There's a lot of high-speed systematic trading that happens in the space. And, as we see small percentage movements with leverage built into the system, that sort of exacerbates the downward pressure on selling. So as we get more institutions that come in, hopefully that will help balance out the volatility as there'll be more players to take the other side of those trades. Lisa, do you have any comments?
I think going back to my point of the banks and their legacy systems, I hate to harp on that, but they can't pivot as quickly, hence the kind of slowing down a bit for them to catch up. The interesting thing is the newer technologies are costing much, much less, right? Because they are using next generation tools. With that being said, we can start to mention the movement into Web 3.0. And I think that brings us to our next topic, which will lead into DeFi and why is the craze now all around DeFi. And I think getting to DeFi is a really the holy grail in essence, but it will be hard to get there, and making sure that those technologies are robust will be a big driver, right? And the regulations on top of it. We can also talk about risk management. And that's also another big part of the applications now that are being built for the institutions. The institutions do have to safeguard assets, and risk management with a lot of new methodologies that from the innovation is happening are making it very unique. So there's some new companies coming out in the next couple of months. In fact, a few this month that will focus on the risk management as an individual as well as an institution. So keep your eyes out. There'll be a lot of fun press releases, and we can continue to talk about some of the other important stuff.
Yeah, I'll just say one other thing about some of the fragmentation that we see in the marketplace in managing risk specifically. So as you can imagine, these large institutions, managing risk is a big part of their day. This is what they get paid to do. When we have situations in the market, like we did a few weeks ago, during periods of high market volatility, there's still issues with some of the infrastructure around trading where we saw issues with some of the exchanges out there that you couldn't trade. The exchanges went down, which means that an institutional account and even retail guys, right, they weren't able to sell positions, meet margin calls, and that's a big problem. And they can't properly manage their risk. So we need to continue to evolve the risk management systems that we have in place in order to do that. And it's an important piece. The institutions I talk to that's one of the major issues for them not coming in with a larger allocation, right? So most of the institutions start with 5 to 10% allocation. They want to come in, they want to test out the infrastructure. They want to make sure that they're comfortable with the execution that they can get. They want to make sure that they have the risk management policies in place to be able to manage that. And then once they get comfortable with all three of those, we'll start seeing the bigger institutions drive more of their AUM into digital assets. It's going to be a natural progression.
I think one part we forgot was the settlement piece.
Yeah.
And that's a big piece of it as well. So I think having real-time settlement mitigates a lot of risk in itself. But a lot of these systems, as Jeff mentioned, they really need to be robust and they need to be back tested. And that's where we're at now. So we're in a little bit of a lull, I feel, but we are moving forward. I'm really excited to see where we go from here.
So let's take a step back and think about the cultural aspects of this for a moment, meaning that we can speak technically all we'd like, and certainly technology enables us to do wonderful and wild and crazy things. But at the end of the day, they're just tools that represent the values of our culture. They're tools that the banks use, and the banks have a fiduciary responsibility, thus the regulators, to help us, to remind us, to coach us, to be guardrails, because we have that maturation cycle. Right. And then I speak about the maturation cycle for a very specific reason. And these guys are going to comment a bit more on it in a moment. And that's because of that observation of moving from the legacy systems and the difficulty they have adopting these new technologies or integrating these new technologies. They typically wait when a new technology comes out for that company or that innovator or that technology to mature and to reach scale. And then they just purchase that company because it's a lot easier than building it up themselves. And it's not just like recruiting people to help them build it. There's actual structural barriers. And so if you think about that sort of the cultural backdrop and the legacy versus the new systems, and then the need for having wisdom about these various processes, wisdom that these people have gotten over decades. I'm kind of curious to have you guys speak a little bit more to the keys for institutional adoption, and to underscore how one of the sort of side effects of where we are culturally and where we are from a technology perspective is that in order for us to move rapidly, one of the key strategic advantages is the ability to form consortiums and to work together, to have people who understand, who are specialized in various parts of the system over the course of 20 or to 40 years in some cases, working together to create these next generation systems that meet the needs of our legacy and institutional systems that were built up over hundreds of years, not just the flash in the pan that we're looking at the past decade.
Yeah, I mean, I think we've definitely touched on some of the major drivers in terms of institutional demand and why it's important to the asset class in general. If you don't mind, I may pivot from that question and focus more on what's happening in terms of regulation in the market and what's happening within the DeFi space.
Could you touch a little bit on stablecoins as you make that transition? Could you touch a little on stablecoins as you pivot?
Yeah, sure. I mean, stablecoins, as we all know, are a very important piece of the infrastructure. A lot of retail traders and institutional traders will use stablecoins as they're executing some of their trading strategies, right? So if they have assets within the stablecoin that are not volatile while they're waiting, for example, like a large institution, they'll receive fiat, right, as an investment, or they may receive stablecoins as an investment, right? They'll hold those stablecoins until they're able to go out into the market and execute the trades that they need to based on what they're seeing and their conviction in any given coin. And stablecoins also make it very easy. Like, for example, when I transfer my own assets from one exchange to the next, I typically do it in stablecoins because you can move that a lot faster than Ethereum or Bitcoin. So that's another piece of it. In my opinion, I would only use stablecoins that what they're backed by, stablecoins that are playing within the regulatory environment today, especially in the United States. I think that's a very important piece, and it's only going to continue to grow. Other areas that we can talk about in terms of regulation, I think it's no secret to most people that are here. The SEC is currently looking at ways to regulate DeFi. There's been other issues in the news regarding some of the lending platforms that are out there. One of the big questions is, how are they creating these large returns or APYs or yields with their lending products? And I think they need to understand how these yields are being generated. And for me, coming from traditional capital markets, to me, it looks exactly like a structured product. And that's why the SEC is concerned and wants to learn more information. We saw in the news, in the crypto media a couple of weeks ago about the SEC looking into Uniswap. I don't know anybody at the SEC. I don't have any kind of inside information, but to me, given my experience in traditional markets, this seems like more of a fact-finding mission, right? So that hopefully when they do come out with more regulation, it's done in a well-balanced way that is also not going to prevent more innovation in space.
Going back to the cultural aspects, I think it really is important to understand that a lot of these markets are being created by developers and computer specialists, computer scientists that are very gifted, but we do need the industry experts to mesh that together. And I think that's been a little bit of a broken piece of the puzzle. You can't create these markets without understanding market behavior. Right, market behavior. And that also touches upon the whole new market that we can now embark on, and which is the unbanked globally. So I think just the change and looking at democratized finance, this is a bigger thing. This is not just the capital market space, but how will markets in general behave in the future? I think these are important questions that we need to answer. I think the regulators are grappling with it. I think they are absolutely throwing a little bit up against the wall to see, what's out there, but that is why they're there, right? And I am happy to say that they are getting much more educated. That's a terrible word to say. I always use that, but I mean enlightened. Educated is under, I don't want to use that word, but it is exciting because they are listening to people. And I love the way Wyoming runs their own process here, where everybody can have their say and really listen to the public. What does the public really want? And I think that's our regulators also need to listen. And we do go to DC. And we are all looking forward to being in DC next week, in fact. I think there'll be a lot of news coming out, so please stay tuned that we should also hear get some more insights on regulation itself.
I'll just make one more brief comment in terms of regulation. I believe it's a good thing. It means that the crypto market is legitimate, right? It means that the crypto market is big enough to draw the attention of the regulators. So for me, it's just another positive that's driving more momentum in the marketplace.
So, of course, I'm sure we could go on, and we would love to, in a lot more detail about the various things we've been working on, and aspects of the industry and how it's maturing. But I thought instead we might take a moment to open now up the floor to questions from folks about the space. Pardon? You want to talk about M&A? Okay, so do you guys want to hear about M&A in the field? Yes? Okay, excellent. So we can talk a little bit about M&A. So future moves and industry consolidation, the ebb and flow of, consolidating, spitting out companies, consolidating, spitting out companies. The large institutions do it. It's almost like breathing in air or the circulation of blood in the system. And we're going to see that same phenomenon within the cryptocurrency space. And so I'm wondering if you guys could speak a little bit to what were the future moves of now that the institutions have entered the space, the regulators are trying to create order and balance. Where do you see M&A going in this space as the institutions look to acquire capability?
Yeah, I mean, that's a great question, and it's again a natural progression for this asset class. I think last time I checked, there's something like 20,000 crypto exchanges out there. It's just not possible that everybody's going to be able to survive and make money in that business. Given my background in my network within traditional banking, I still keep in touch with a lot of the guys, from the large investment banks that now have dedicated fintech teams and digital asset teams. We've already seen some mergers in the space. Kraken has been active, Coinbase as well. One of the biggest ones recently was Galaxy Digital and BitCo. That was the first $1 billion M&A transaction in crypto, and that was a huge success, in my opinion. If you look at the current landscape where we are, we've seen a tremendous amount of venture capital and investments from traditional banks coming into the space. That's not going to slow down. That's only going to continue. the current playbook, as I understand it, that a lot of these guys are using is they're coming in and figuring out custody first. But we've already seen banks like Goldman Sachs that have launched a derivatives trading desk. And the other big banks are not far behind. They're all starting slow while they figure out custody. And then, in my opinion, based off what I'm seeing in the market, 2022 is going to be a big year for M&A activity. We'll see consolidation within the exchanges. We'll see consolidation within custody. We'll see the large investment banks come out with crypto prime products, which is something that Coinbase is already trying to do. And there's other players in the space. So they're going to get involved. And I expect it to be a very busy year in terms of M&A.
Yeah, I agree with everything you're saying. Again, we can go back to DeFi. And how does that relate to DeFi? Because that's just the big elephant in the room right now for the banks. And I wish we posted, Michelle had an incredible caricature of an elephant sitting, with the regulators on the one side and the banks on the other, and the big elephant sitting there, which is DeFi, right? So how do we deal with that? And I think we need all of our brains. We need all the brain power we can get to how do we roll this out? And it makes sense, but there are a lot of moving parts. Most importantly, KYC, right? AML, how do you control? Who is on each side of that transaction? Are they following the rules, right? Who is it? That's really important. And I think there is a mass amount of money being spent on that right now, and somebody hopefully will get it right. We're getting close. So any of you that see those companies, please present them to me, because I really need them for my banks, asset managers, and fund managers out there.
All right, so let's open it up to questions, as we only have about 10 minutes left here. So, yeah, the gentleman with the sunglasses on in the back, you were first.
So with Uniswap V1, that's a locked smart contract, no admin keys. What do you do with that? What you said the SEC is going to look into that, but is that not Pandora's box? You can't put it back in the page.
That's a good question, and probably best answered by somebody who specializes in smart contracts. I'm familiar with them at a high level. I agree, it's a challenge, and I think that's why we haven't seen any kind of regulation yet. But to me, it's not really about the smart contracts. It's more about what we'll probably see in DeFi is the need for AML and KYC. So do you build AML and KYC into that smart contract?
It's immutable. Uniswap V1 is immutable. You can't add, or there's no admin keys. There's no adjusting.
Well, in that sense, but there are other ways to do it. So yeah, with Uniswap, I agree that makes it a challenge, and I'm sure that's what they're trying to figure out. I don't know what the answer is. I can't answer that question. It's for somebody that is has a higher understanding of smart contracts and the engineering and development and the coding behind them. And is it really immutable? I mean, to me, it seems like it is, but is there a way that you could change that in the future?
Or shut it down.
Or shut it down? Yeah.
The only way to shut it down currently is to kill the Ethereum.
Right, which I don't think will happen.
Or make adjustments to it, right? So I know the regulators, FATF has said that they really want to take a hard look at DEXs, and they actually were thinking of outlawing them, which of course made everybody very nervous and very angry at the same time. I believe that we're going to come up with a solution where there's KYC in order to use a DEX, and that it's going to change the nature of these platforms, and it's going to change the way that we use smart contracts. And this is something I believe that we're going to see movement on within the next 12 months, because FATF has gotten really serious about it, and we can't move forward as an industry until we solve this KYC, know your customer. And it's not just about taxation, it's also about money laundering, anti-terrorism, gun running. So this is something that globally nations want to solve, as well as the actual financial institutions. And I don't think they will spare the rod when it comes to protecting wealth across the Western markets.
Yeah, I mean, I agree. Lisa, do you have any comments on that? Okay. Any other questions? Sorry, couldn't really answer that for you. Yes.
So, you had mentioned before, like with yourself, you're an aggregator. And kind of relating it back to KYC AML, one of the big issues is with all these exchanges, you have to basically go through KYC AML. Can you now go to your, for example, prime brokerage, open one account, do one KYC AML, and then get access to everybody without having to go through additional layers?
That's exactly it. That's the beauty of it. So when you open an account at FINXFLO, whether you're an institutional account or a retail account, you only have to go through the KYC process with FINXFLO. You as an individual, you face off legally against FINXFLO, and then FINXFLO has already gone through the AML and KYC process with all of our liquidity aggregators. So FINXFLO then faces off between the rest of the market. So yes, it's very easy to go through KYC, AML. You have one wallet, one account, one KYC, and you can access liquidity throughout the entire market.
The only thing I could add to that is read your contract thoroughly that you have, right? So if you are opening that up, they're generally very long and understand all the aspects of that contract that could impact you. Because yes, it is very clear, the KYC, but there are so many nuances today. And we've seen it, and Mary Beth, again, we'll talk about it in the next panel, the Suez exchange, just avoiding so many of the rules and regs and nobody caught it. So that's other aspects we need to think about.